From New York City for our audience worldwide, Bloomberg Real Yield starts right now. Coming up, the American economy delivering higher prices. Federal Reserve officials determined to stand firm as high-yield credit spreads drop below 3%. We begin with the big issue, more fuel for the great inflation debate.
It doesn't take much to rekindle inflation concerns in this marketplace right now.
PPI pressure are likely to be ongoing.
This data is going to focus attention even more on the inflation issue.
What happens if we get more inflation data?
And the question is, are we then on a rising trend or not?
The Fed saying it's going to be transitory.
It's going to take the Fed quite a while to figure out whether transitory is indeed transitory.
If inflation actually remains high,
this is a high-risk policy scenario.
The Fed will find itself in a very difficult position.
From proactive to reactive,
it's becoming a real issue.
The Fed in general will remain less concerned about inflation than the markets will.
Markets tend to be, have a short fuse and be very, very impatient.
Let's bring in today's panel. Franklin Templeton, Sonal, Desai, Columbia Threadneedle's Tannuzzo, and Swell at Goldman Sachs Asset Management. Sonal, let's start with you and talk about the difference between something that's transitory and something that's a little bit more sinister. What's the distinction for you for the months ahead?
So I think what's really interesting is everyone says transitory. Fed Chairman Powell said transitory. What is transitory? Is it 2 months? 2 months, sure, it's transitory. 2 quarters, a little bit less so. 2 years? That's the problem. Transitory has not been defined, and I think that there's a very real risk that it's not 2 months, it's not 2 quarters, but it's potentially even more than 2 years. So that is an issue.
2 years. Swell, what's your take on that?
I think that, to use a literary analogy, we're waiting for Godot, and Godot hasn't showed up for 20 years, and I don't think Godot is showing up over the course of the next couple of years. We have right now a data tantrum going on in the US where everybody's freaked out about short-term data. If you look at the equity markets, they're looking through it, they're looking to next year, the year after. But the bond market, for some reason, and I think it's for hedge purposes, is owning up to this inflationary trend. And in general, we think we're very much in the camp of transitory and are of the view that next year, the upside case for inflation is where we were pre-COVID.
Mike, you just said something really important. I want to pick up on it. You just said the word hedge there, and I wonder whether you can elaborate on that. Are you saying some of the price action we're seeing is just a consequence of hedging and not a consequence of conviction trades around the outlook for inflation?
I think a lot of what's going on is hedge related, but it's kind of the opposite of the traditional hedge. The traditional hedge for equities and growth and risk assets is going actually long duration. In the event that there's risk off and lower than expected growth, you would actually see a rally in rates. But I think right now, everybody is so focused on taper tantrum risk. And so as a result, everybody thinks that a little bit of inflation and higher rates are going to end the party. And so I think that a lot of the action right now that's going on is hedging equity exposure. And I think that it could end pretty badly for some people.
Gene, I want to bring you in. Weigh in, please.
Well, I think we need to break down what we know and what we don't know about inflation. What we know is that prices have been low and stable for 25 years. But we also know that after a deep recession that we are still trying to come out of, if you're a Fed policymaker and you're looking at Bloomberg TV and they're talking about the prospect of rising and sustainably higher prices, you're doing backflips. This is exactly what you wanted John Ferro to be talking about in April 2021 compared to where we were a year ago. Now, does it get out of control? That's really the question. And what we know as well is that the signal to noise ratio over the next 6 months is going to be extremely low. There's going to be a lot of noise coming through the inflation data based on acute supply bottlenecks rather than a true wage price inflation spiral. So I think we need to be humble to the fact that there's going to be a lot of noise and we're embarking on a policy experiment that we haven't seen before. So I tend to agree with Mike that I think the broader trend is still intact, the secular disinflationary forces over the last 2 decades. But the truth is we don't know. We haven't had this type of experiment before.
Sonal, I cut you off a little bit early, so let me bring you into the conversation to respond to that, please.
So, okay, I would say the last 25 years, absolutely. Look, I'll hold my hand up. I've been an inflation hawk and I've been wrong. But let's put it this way. In the last 25 years, when have we had 2 years when you've had 15% of GDP budget deficits year after year, first of all, increase, and this is not even counting the 2 or whatever trillion, I mean, a trillion here, a trillion there. I mean, who's counting, right? We're talking about 5 trillion already, which has been assigned to this recession. So we're talking about close to 30% of GDP in debt accumulation over a 2-year period. That's number one. This is happening at the same time that the Fed's current QE is larger than QE 1, 2, 3 put together in a shorter period of time. And number 3, you have a period where, because of vaccine distribution, you are essentially going to have an economy booming. If you have any one of the 3, I would buy it. And I'd say that inflation's not coming. You have got all 3 pointing in exactly the same direction. So I agree, we need to be humble about what we will see and what we won't see. But when we talk about an experiment, I think the experiment is a different one. We have never thrown this much of stimulus at a recovering economy before. And an economy, sure, Q2 last year, the last time we did 2 trillion, we were on the verge of having an economy that shrunk by almost a third in annualized terms. This time around, we threw almost the same amount, the 1.9 trillion, at an economy which is likely to grow this quarter at double digits in annualized terms. Bottom line, are we really saying that there are no consequences? Which is fantastic. I feel like I'd say an old fogey in the sense that clearly you can print, you can essentially do whatever you want with absolutely no consequences, which I find actually fascinating. In which case, why stop at 4 trillion or 5 trillion? Why not do 12 trillion? Why not have a UBI, but why stop at $1,000? Why not do 3,000 if there are no consequences?
Well, Sonal, if Congressman Ocasio-Cortez is listening, she might be getting some ideas, because there are some people within the Democratic Party that quite like the sound of that. Mike, to bring you back in, Sonal's gone through it point by point by point. You're talking about secular headwinds to yields over time. The trend of the story in the previous cycle will kick back in again. What is unconvincing? And I'm not sure you're saying, Mike, that there won't be consequences. What is unconvincing about the inflation argument for you specifically?
Well, first off, I can never make the comment we have to be humble, because everyone who knows me knows that I'm not. So, I think the argument that is challenging is that we've been through many cycles over the course of the last 20 years, and we have not gotten really to full employment, to wage pressures, and there are a lot of reasons for that. Technology obviously has played a very, very significant role. Globalization plays a very significant role as well, and what we have right now is we've had the global economy completely shut for almost a year. And while we're going to have short-term spikes in growth and demand and we're going to have supply chain issues that are going to cause prices to go up, in the long run, as an investor, we have to be able to see through short-term effects and look at, okay, when things normalize, what will the world look like? And there's going to be scarring that comes out of a massive crisis like we just have experienced, that's going to have an impact on the demand for workers. That's going to have an impact on the ability for companies to raise prices. You have countries outside of the US, you look at Europe, that's continued to be mired in slow growth, bigger challenges, bigger vaccine challenges and COVID challenges. You have the emerging markets, very, very significant challenges there as well. We're not just going to wake up next year and the year after and see just massive levels of growth and inflation. So there are a lot of factors that will cause us to be in an environment, we think, in 2022 and 2023 that looks a lot like, much more like 2019 than a 3-month period because of short-term stimulus.
So, Mike.
Okay, if I can, sorry, if I can just jump in.
Sure.
If I can jump in with Mike, I just wanted to check a couple of things. First of all, what I'm talking about is really, are we talking about a couple of years or a couple of months? So that's number one. So what is temporary? It's a little bit like transient. These are words which don't actually fill out. The second thing I'd note is when we talk about massive, I'm not talking about massive. I'm just saying we probably are not going to be sub 2 again. And I do think that there's a realistic chance that we're significantly above 2, which doesn't mean 5, but yeah, we could be approaching 2.5, 3. So that to me is not in the price, and maybe it could go up even further for a period of time. So those secular challenges, which is over 3 years, for me secular is 10 years, those might revert. But I think that the snapback, certainly this is a crisis we've never seen before, but it was a mandated shutdown of the economy. The scarring, I accept to some extent, but again, the scarring to me is you mandate a lockdown, people can't go to work. You open, people go to work. So I'd be curious to know as to how long that scarring actually lasts relative to the global financial crisis, when people were shell-shocked and traumatized by the wiping out of their net worth, which happened because of the housing crisis.
Gene, let me give you the final word, because Gene hasn't spoken for the last 5 minutes. Go on, Gene.
Thanks, John. I think there's something we're missing here in this debate, which is where is the pent-up demand and where are the supply bottlenecks that we're seeing? The data that we're looking at here, producer prices and things, these are goods, right? Goods are things we've all been able to buy readily for the last year, and that's where the bottlenecks are. The pent-up demand is not in goods, it's in services, it's in experiences. And I don't think there are supply issues there. I think there are still plenty of seats at movie theaters. I think there are still plenty of empty seats on planes and empty planes sitting in deserts that can absorb that supply. So I think it's going to be very uneven, because you can't make that statement for every sector. If you're looking at housing and building materials, the opposite is true.
One thing I know for sure, this job would be much easier if you were around the desk with me, for me to moderate things, but you're not. And I look forward to that happening sometime soon. Guys, stick with me. Up next, the auction block, the junk bond bonanza marching on. Issuers continuing to flood the market after a record first quarter. That conversation up next. This is Bloomberg. From New York City, for our audience worldwide, this is Bloomberg Real Yield. It's time now for the auction block, where we kick things off over in Europe with one of the continent's most indebted nations getting flooded with orders. Italy receiving more than 60 billion euros of bids for its first new 50-year bond offering in 5 years. Moving to the US, where volume was subdued in the high-grade market, sales falling well short of dealer estimates despite numerous deals this week. But borrowers flooding the high-yield market, with yields hitting record lows. News Corp kicking the week off and upsizing its offering by $250 million to fund its acquisition spree. I'm pleased to say, back with us is Sonal Desai, Tannuzzo and Mike Swell. Guys, a failure of me to identify firstly, the distinction between the way you guys are looking at the world and the difference at the moment, but then failing to really talk about what it meant for your view on the market. So, Mike, I want to start with you. We're familiar now with the way you're looking at the world, what you think about inflation, transitory, etc. What does that actually mean for the decisions you're making right now, the money you're allocating?
It's a few different things. One, I think we're pretty comfortable we'll have accommodative policy globally for a while. We're okay owning some interest rate risk longer on the curve in countries like the US, in Australia and Canada, where you have pretty steep curves and you're pricing in a very significant recovery and a very material change in policy. We're still overweight credit, a little bit in high yield, finding emerging markets actually to be a little bit more interesting now. But the main thing that we're doing as an institution is we recently, at the beginning of this year, combined our merchant bank with the public asset manager. So we now have a public and a private credit investment capability. And we're talking to clients a lot about the ability to be able to go from the public markets, which have been picked over by everyone, all the money's flooding into the public markets, to actually looking at private credit as a way to pick up return, give a little bit of liquidity, but to really be able to get a lot better terms than what you're getting in the public markets from a covenant standpoint. So I would say a little bit less overweight to credit risk in the public markets, but really thinking about the private markets as a really good opportunity in an area that's underinvested by investors.
Yeah, Mike, I want to pick up on that final point in just a moment. So I want to bring you into the conversation, because a clear difference between the way you and Mike view the world right now, and I just wonder how much daylight there is between how you allocate money as well.
So I'd say that we're less comfortable with long duration, unsurprisingly, given the views that I just described.
Yeah.
So we're less comfortable with duration, particularly in the US, to a lesser extent in Europe. I do think European yields get dragged up a bit, but for all the reasons you mentioned as well, we do think actually Europe is going to be lagging. The US is a special case. There really isn't another country which is doing as much as the US in a scenario like the US. So shortening duration, we're a bit more positive on high yield, and we also like floating rates for the same reasons that we're anticipating continued steepening. We also like private debt markets, and in our broader Franklin Templeton, we have some very important private debt players in BSP, and those alternative markets are definitely interesting. We're in a situation where people are getting driven more and more into riskier asset classes, and it's inevitable in a sense at a time when liquidity is this abundant. And finally, yes, we do like emerging markets, in particular hard currency EM. Again, very specific pockets. We're not doing wholesale buying of any indices.
What about you, Gene?
Yeah, a little bit different for us, John. I mean, I think if you look at the last 6 months, the opportunity, the tug of war between duration risk and credit risk has absolutely been skewed toward credit risk. And that's been the place to be. And I think now when we look at the broad optimism in markets, we see a lot of that reflected in prices, particularly with the Bloomberg Barclays high yield index having spreads below 300 basis points for the first time since pre-great financial crisis. So we're starting to balance out that mix of duration and credit a little bit more, taking advantage of the fact that interest rates have gone higher. So we are adding duration coming from a very, very short duration position to one that is, slightly less so. But I think there's something to take into account here, related to the conversation we had before, which is, look, if we look at how the market is priced for the Fed's been producing its interest rate forecast for almost 10 years now. And this is one of those few times when the market is pricing interest rates higher than the Fed's forecast. Each of the times in the past, it's been a pretty good time to add duration. So we're starting to do that to portfolios. And on the credit side, just think a little bit more, be a little more picky, not just buying high yield, in total, but looking for upgrade candidates, looking for shorter maturity opportunities, bank loan opportunities. I think that's where the value is.
Well, let's just pick up on the final point and talk about credit. Mike, I'd love your view on this right now. I think it's so unusual to see what we're seeing at this stage of the cycle, if we can even consider this the beginning of the cycle, where high yield spreads are at the moment, south of 3 percentage points. If you look at the tights of the previous cycle, if we even left it, it was back in 2018. You look at the tights of the cycle before that, it was 2007. It was right before those cycles ended effectively. Mike, just how unusual is this moment to see spreads as tight as they are before this recovery has even really gotten started?
I mean, it's not incredibly unusual. As you know, Jonathan, markets look forward and they're pricing in a very, very strong kind of growth and earnings outlook over the course of the next couple of years. But I think the credit markets are also more in my camp with regard to rates staying low and really credit benefiting from the combination of very easy monetary as well as easy fiscal policy. I think one thing that is important to note, though, is that the high yield index is made up of kind of 3 different investments. You have kind of the equity-like securities, you have the traditional kind of high yield, highly levered, and then you have double Bs that are much more rate sensitive and more like investment grade credit. And when you look at that, you actually see that the double Bs that are much more rate sensitive than the rest of the market have actually underperformed. Triple Cs have brought that index in massively, but the double B sector is still offering spreads that are well in excess of what you get in triple B land. So there is still some opportunity there, but I agree with the points that we've all made here, is that most of the public credit markets have seen their better days. And really, the private credit markets are where really there's some return for the given level of risk. And you've seen just a massive growth of the private credit market, I think in a positive way, not a bad way. It's mainly because you've seen companies that were in the public equity markets now are in the private equity markets, and they're issuing in the private markets. And the banks are not providing the capital and the lending to private companies. And it's a real opportunity for investors to give a little liquidity and pick up returns of where high yield was many years ago.
Guys, going to be sticking with me. Still ahead, the final spread, the week ahead, featuring another round of Fed speak, including Chairman Powell. He's doing it again next week, and I believe through the weekend as well. More still to come from New York. This is Bloomberg. I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the final spread. The week ahead, coming up, another massive 5 days for the Fed with at least 10 different officials on tap. Chairman Powell, Vice Chair Clarida, both speaking on Wednesday, plus lots of economic data to watch for, including CPI figures, followed by another round of jobless claims and retail sales coming on Thursday. Back with us for some final thoughts, I'm pleased to say, is Sonal Desai, Gene Tannuzzo and Mike Swell. Gene, Tuesday, that's what it's all about, right? CPI in America. When we first get to see that 2 handle and more and maybe a push towards 3, is there anything the Fed has got left to say that they haven't said already?
No, look, I mean, this is where they can prove their point on flexible average inflation targeting. You know, we all wanted to see the day when inflation goes above 2 and they actively do nothing about it. And that's exactly what we expect to see here. And we're in that period again, as I mentioned earlier, where the signal to noise ratio is low. This is a lot of noise. And I think Sonal's got a great point. If we're still talking about this, 2 quarters, 2 years from now, that's a big deal. But 2 days from now, not that worried about it.
Mike, don't you find it odd that if you and I were in London right now in the city talking about the Bank of England looking through higher inflation, we'd be talking about 3-4%, like Governor King did 10 years ago. Why is 3% at the Fed so controversial?
By the way, he was my professor at LSE.
Was he?
Many, many moons ago. First of all, we probably would be on Zoom in London, so we might not be able to be together. But, why do I think different countries have different tolerance levels for inflation, and why is 2.5 okay now? It's okay now for the points that were just made, is that I think most people in the market view that we're going to have elevated inflation for a short period of time. I think the Fed recognizes that. And I think the Fed changed their policy directive pretty meaningfully last year, where they want to target for an extended period of time inflation that runs at the average. And as a result, they need to see a certain period of time over the average. And they really want to get to what they view as really full employment. And we thought we got there at 3.5, and we thought we got there at 3, and we didn't. And so I think there's just a higher tolerance for running a hotter economy as the Fed recognizes that the bigger risks are deflation versus inflation running out of control and impacting growth.
Mike, we've got to leave it there. Mike Swell, great to catch up with you. Sonal Desai, Sonal, thank you. We've got to get this panel back together again, alongside Gene Tannuzzo as well. From New York City, that does it for us. We'll see you in a couple of weeks' time at 1 p.m. New York time, 6 p.m. in London. This was Bloomberg Real Yield. This is Bloomberg